This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Caution returning to the markets for now as investors await crucial US inflation data. Treasuries and oil gaining on war worries in the Middle East and Ukraine. Chinese brokerages are said to be cutting back trading of government debt to help curb a bond rally, with some rural banks told not to settle their purchases. And shares of CSL in focus after profit falls just short of estimates amid low expectations going into this Aussie earnings season.
And Heidi, really, we saw again the market volatility, but mostly in bonds and oil, as we saw those prices gaining ground on geopolitical risk on multiple fronts. Whether we're talking about the ongoing war in Ukraine, we're now hearing from a Russian regional governor saying that 28 Russian villages and towns were taken over by Ukrainian forces. This would be the first time the foreign military has taken control of Russian territory since World War II. And of course, we just had Israel also being downgraded to A from A+ from Fitch. Of course, the war around Gaza and the conflict ongoing right now are waiting for any potential moves by Iran at this point.
Yeah, it is that sort of bracing for the almost seen as inevitable retaliatory attack, right? And in fact, the US saying that they believe that we're closer than ever when it comes to that reprisal from Iran or its proxies. It could come as early as this week. The other thing, of course, we're watching is some of the gyrations when it comes to China markets. A lot going on when it comes to the sort of proliferation of policy that we've seen from leadership in China, particularly when it comes to what we're seeing in the bond market, right? Chinese regulators, we're hearing, are telling some of their rural lenders to renege on their bond trade. Regulators have opened up probes into bond trading at banks, and authorities are really seeking to calm this massive bond market rally. And we are seeing pricing in these markets suggesting that so far a lot of these efforts are really taking hold. We're hearing that commercial banks in Jiangxi province have been told not to settle their purchases of government bonds, taking some of the most extreme measures yet that we've seen to try and cool this market rally down. We've seen several rural banks failing to settle their transactions on the Monday session after that order to halt purchases late on Friday. That's according to people familiar with the matter. It is just one way to prevent banks from taking on excessive bond risk, but obviously, Shery, this just adds to the concern over market integrity, transparency, and free market operations for Chinese risk assets.
Yeah, we'll continue to watch the gyrations in Chinese bond markets, with bonds plummeting by the most since 2023. But you can take a look at Chinese A50 futures now finishing to the downside of 0.1%. When it comes to Nikkei futures right now, really not doing much. We are coming back from a holiday here in Japan. Of course, we saw the market gyrations just last week, finishing on a bright note when it comes to the Nikkei and the topics on the Friday session. But when it comes to the entire week, we're talking about 4 weeks of losses. And of course, that incredible plummeting and really plunge that it took on Monday, and a little bit of recovery throughout the week. But what we're watching is the Japanese yen. Of course, we had a little bit more upside on the US dollar in recent days, and we continue to see whether or not strengthening of the Japanese yen could lead to more unwinding of these carry trades. But right now, a little bit of weakness across the board. Take a look at how US futures are coming online in the Asian session. We finished the S&P 500 flat in the overnight session, but of course, we've been watching the Treasury space because Treasuries gained ground again with the 10-year yield falling towards that 3.9% level on those geopolitical concerns on multiple fronts at this point. We're watching oil prices right now under a little bit of pressure and below that $80 a barrel level. But this is, of course, after the biggest jump since October, not to mention the second best day of the year for oil, Heidi.
Bloomberg Economics, Shery, seeing both a PPI and CPI prints coming in soft, but some components may still show persistent price pressures that could impact the Fed's thinking. Bloomberg's chief US economist, Anna Wong, joins us now for more. So, Anna, we're at this point in the markets and in terms of expectations where, of course, every data point, particularly when it comes to price data, has such a meaningful impact. What will you be watching out for in terms of what we could potentially see?
I would be watching out for whether the PPI and CPI in the next 2 days what that would imply for the inflation measures that the Fed cares about, which is the core PCE inflation. And based on what we know today, we're expecting the financial services portfolio management component in tomorrow's PPI to be pretty solid, which actually would likely boost the core PCE inflation to 2.7% from 2.6%.
What does that mean when it comes to filter through into the CPI numbers and, of course, the expectations for where the Fed goes from here?
Yeah, so, I mean, I think when you're just looking at the PPI or CPI report in the next 2 days, a naive look would be like, oh, great, it's soft. But then when it comes to the Fed's favorite core PCE deflator, it's heavily weighted toward Medicare, healthcare, and financial components, which means that it could be that despite the soft CPI and PPI print, what you will ultimately get in core PCE is something that actually looked pretty strong. And I think the market wouldn't like the idea that the Fed is not going to do 50 bips of cuts in September, which is what the market is pricing. So if that our prediction is true, that the core PCE actually accelerated rather than softened, I think the market is going to be quite upset about that.
And I do wonder, looking forward, how much risk are you assigning to the inflation outlook if there's meaningfully more fiscal looseness after the November election, and if there's more sort of pro-growth, which could very well translate to pro-inflation?
Yeah, so typically in the first administration of anyone, whether it be Biden or even Harris, one could expect the fiscal impulse to be loosening because all the presidency wants to do something big, right? And I think that positive fiscal impulse would come just as the economy is weakening significantly. So our baseline for the next couple of months is for the unemployment rate to rise to 4.5% and to 5% next year, which means that the economy actually needs some counter-cyclical fiscal policies next year.
Bloomberg's chief U.S. economist Anna Wong there with a preview of economic data out of the U.S. And, of course, with all of the geopolitical tensions as well this week, we have seen a little bit more upside when it comes to the U.S. dollar. But our next guest says there is room for a weaker dollar. Joining us now is Mahjabeen Zaman, head of FX research at ANZ. Mahjabeen, great to have you with us. Are your calls on potential weakness in U.S. dollar mostly based on Fed rate cuts and rate cut expectations?
Exactly that. And, we think, of course, we have seen a little bit of dollar downside already. We think there is more room to go into year end, particularly in Q4, just on the back of seasonality, which you see at the end of the year, and, of course, actual rate cuts rather than expectations.
What does this mean for trades on the other side? Because, of course, we have seen that Japanese yen strength in recent days leading to a huge unwind of carry trades. If we continue to see more weakness, does that mean more upside for the yen, and by how much?
Look, I think at this stage, we are looking to continue seeing a strength in the yen. We think it will be gradual. I think for the yen, it's a little bit of a different story. Of course, it's a dollar impulse, but it's also what's happening locally in Japan. We are expecting the Bank of Japan to continue its tightening cycle. We're expecting another rate hike in October. And I think that's going to further support yen strength into next year, particularly. And, of course, the quantitative tightening that's coming along with it as well in Japan.
How far along are we with the unwinding? Do you expect just more bouts of volatility as it continues to progress?
Look, I think for the carry trade unwind, which we saw, of course, last week, I think you need three things to take place when you undertake a carry trade. And one, you need to have low volatility. We do know that August seasonally it tends to be a volatile month, a function of a little bit of illiquidity because it's a summer month and summer holidays. Many people are away, traders are away. Second point, you need to have expectations of lower rates on the short currency. Clearly, that's not happening. As I spoke about Bank of Japan, they have shifted and will continue to shift higher. And I think the biggest point, and which I thought was the main driver of the shift we saw last week, was the U.S. growth resilience not being there anymore based on the jobs data. I think this is the data. If this continues to, show drastic movements, especially the job market, I think then you're going to see a little bit of more of that volatility in this pair.
What about the political risk when it comes to the US dollar? Do you think as we head towards the election, we know that at least one of the candidates would prefer a weaker dollar? Does the dollar still kind of retain its haven, superiority, or does it start to behave differently?
I think that's a great question, and we have done some work into previous cycles. where the Fed was easing, and at the same time you had U.S. elections, and net we had seen that the Fed policy tended to dominate moves in the FX. And if we go back to, if you look at the Trump era, Trump 1.0, soon after he was elected, we did see dollar rise. And that's because it was unexpected win at that time, non-consensus. But then again, at that time, throughout his term, the Fed started raising rates as well. So we had dollar strength, not just because of the trade wars. Of course, we had a little bit of that contributing, but then we also had that the strength in the dollar coming from the Fed hikes as well. So I think what the Fed does may be a little bit more important into the environment as we go into next year, depending on, of course, who wins the elections.
Let's talk a little bit about China. Of course, very consequential who wins the election in the U.S. for Beijing as well. At this point, they're struggling with their own market gyrations. With that incredible bond rally, we've now seen measures to tame that rally right now at a time when we're also expecting interest rate decisions, not to mention activity data out of China as well. When you take everything into account, where is the yuan going?
Look, I think we continue to see, we have seen yuan benefit on the back of a weaker dollar. We continue to see a stronger yuan, and I think it's going to continue to see the impulse coming in from the dollar and how that links up. And I think, to some extent, I think the People's Bank of China might be a little bit pleased to see that they do not have to come in and intervene. We do know that 730 was the line in the sand last year, and I think we're well far away from that at this stage, in which PBOC will have to be concerned about.
Mahjabeen, always great to have you with us. Mahjabeen Zaman, who's a head of FX research at ANZ. More ahead on the Asia trade. This is Bloomberg. Take a look at oil trading over the last couple of days. We are seeing prices soaring above $80 a barrel. Now, traders really pricing in a potential reprisal for Iran that we're still sort of waiting and seeing. Tehran on Sunday reiterating its determination to punish Israel. We did see WTI crossing that 200-day moving average, which has sort of been a buy indicator there as well. So supercharging that upward momentum, despite, of course, we heard from OPEC Plus downgrading some of their demand expectations as well. Analysts really saying that some of this is really kind of the algorithmic trend, and the followers there still holding dry powder when it comes to Brent. So could see potential additional buying once we do see that action taken potentially by Iran. Well, Israel's sovereign debt has been cut by one notch by Fitch ratings. The war in Gaza, of course, weighing on public finances. Fitch lowered Israel's score to A from A+, citing geopolitical risk. Fitch analysts see the conflict in Gaza lasting into 2025, with a chance of it broadening on other fronts. Moody's ratings, meanwhile, giving Israel its first ever sovereign downgrade in February, cutting it one notch to A2 with a negative outlook. The US believes that an Iranian attack against Israel may come as soon as this week, as leaders continue to work to de-escalate tensions in the region. Bloomberg's Michael Heath is with us now. So what are we hearing?
Yeah, well, the National Security Council, the US National Security Council, the spokesman there, was basically saying that they see the risk of potentially a significant attack, which may come as soon as this week. And they say that that's Israel's had similar. That's their assessment as well. So I guess everyone's sort of girding for something to happen in the near future. I guess what was interesting was significant attacks, because this is the question. In April, obviously, we had a similar situation, but Iran, it really broadcast ahead of time what it was going to do, enabled a coalition with Israel and the US and others to shoot down most of the projectiles it sent, and Israel responded with a token bombing of its own, and that was done. It looks like this is going to be more serious, and I think that's what's being reflected in making markets jittery there. On the front with Israel, there's sort of tension domestically, because you've got Netanyahu still saying that he expects total victory. You've got his defence minister saying that that's just not in the cards. You can't actually win a total victory in Gaza, kind of thing, for the obvious reasons that it's a sort of an insurgent war. So Yeah, I mean, this idea that it would go on to 2025 seems to me inherently reasonable because there's more wars to be fought, and the further we get away from October 7th, the less pressure or less connection Netanyahu has to being in charge on the day of that security catastrophe, basically. And so it's in his political interest to keep. Not to wage war just for political reasons, but not to urgently seek peace or seek an end to this. And we've got talks on Thursday with the Western nations and Arab nations trying to push for a ceasefire, but it just seems increasingly unlikely now.
Which is interesting because it feels like with each, for example, with the airstrike on the school in the adjacent mosque we were talking about yesterday, the condemnations from Western leaders are coming faster than ever. It doesn't sound like platitudes at this point because it doesn't feel like anyone has a real expectation that the two sides can be talked down.
It's really true. I mean, that was a horrific attack on the school. I mean, the images that just came out were just terrible. And you're right. And everybody is jumping onto it very, very quickly. But Hamas is basically not going to show at these talks, and the Arab nations say they're going to brief it. But Hamas is sort of like, well, we've got a deal. It's just, are we going to go forward with it? There's no need for talks on a new deal.
The main negotiator was also killed.
Exactly right. Yes. So it's sort of hard to talk across from that. But the basic idea was that Hamas wants Israel to withdraw. Israel is prepared to accept a pause, but wants the option to resume fighting, which obviously doesn't suit Hamas. So we've got a deadlock kind of there. But it just seems that these hostages are sort of trapped in limbo. And there was an awful report. I mean, Hamas announced that one male hostage had been killed and two females severely injured. They said basically their guards were responding to the air attacks that Israel had conducted in Gaza, and in fury killed somebody. So it just highlights again what the incredible situation those people were in, let alone the people within Gaza who are under this bombing as well. So it really, really is just a tragic spiralling, disaster there.
Of course, a disaster, with the war being fought on another front between Russia and Ukraine. Very interesting sort of televised announcement and sort of conversation, a meeting with defence officials where Vladimir Putin really abruptly cut off an acting regional governor who was talking about Ukraine's military having taken control of part of this area, right, 28 towns and villages in the Kursk border region. Does this suggest that there's the Russian vulnerability here showing?
I think it definitely suggests that. I mean, look, a year ago when we had this rebellion by the Wagner private army, they basically almost marched to Moscow with nobody standing before them. And Ukraine has sort of, I guess, they can't, the areas of Ukraine they're trying to take back are so heavily fortified, it's very difficult to make any progress there. So they've gone into Kursk, which is basically, it looks like unguarded. And it's hard to work out what their ultimate objective is. Is it to try and seize this ground and use it to negotiate a peace in the end? You give us back some of our territory, we'll give you yours. Or is it to try and draw Russian troops away from that stalemate or the bit of progress Russia have been making in the south? Or is it just to create maximum trouble for Putin? And probably they've done all three once. But what it shows is that Russia really can't. This state that Putin sort of tries to demonstrate or show the strength of via his propaganda on TV, when push comes to shove, there's actually not a lot there. And you see these people in the streets in Kursk who are complaining to Putin directly. There's no one there to help us or anything because the state is almost dysfunctional there. You don't want regional governors talking about how bad things actually are, so it's not surprising he would cut him off.
Yeah, he certainly wasn't very happy that was being aired on television, right? Michael Heath there with the very latest. We do have more ahead on the Edge of Trade. This is Bloomberg.
Chinese regulators are said to be taking some of the most extreme measures yet to cool a bond market rally. Sources say commercial banks in Jiangsu province have been told not to settle their purchases of government debt. China correspondent Min Lo joins us now in Hong Kong. So, Min, we've heard these warnings coming from authorities for a while now. So how significant are these measures?
Yeah, it is part of a slew of different measures that are now working in tandem to arrest that bond rally that we are seeing. And some of that measures have been working because yesterday you saw that 10-year bond yield going up 4 basis points to 2.24%. That is the highest we've seen in 3 weeks. And so yesterday there are these several rural banks that have failed to settle their transactions after authorities told them to stop buying bonds. And some analysts are saying that this is quite an extreme measure because reneging on bond transactions could undermine market stability if the counterparties then start to expect or worry about more failed transactions in the future. And we also understand that these Jiangxi authorities had initially rescinded that order before reinstating them, which suggests that even the officials are also struggling to, find the right balance here as they try to inject market stability while, preventing this bull run in the market. And at the same time, we understand from at least 4 brokerages that they are cutting down on sovereign bond trading. Most of them are saying it's a voluntary move, although at least one is saying that they are following guidance from the authorities as well. And yesterday as well, the state banks continued to sell 100 million yuan batches of the 7-year bonds. And you have authorities also being slow to approve new bond funds as well. So a number of measures are working together at the same time to help to lift those bond yields.
Foreign investors have pulled a record amount of money out of China over the last quarter, and perhaps unsurprising given a lot of the downward sentiment and concerns over transparency and policy making.
Yeah, that's right. So it reflects a bit of that pessimism in the economy. Foreign investors taking out $15 billion from the Chinese economy in the second quarter. And that's only the second time that we've seen that number turn negative. In the first half of the year, it was down $5 billion. And if this trend continues, this will be the first year we would see an annual net outflow of investment from China. And there are a number of factors at play here. You have the geopolitical risk that could be causing some companies to cut exposure to China. You have the weak domestic economy as well, and China's surprise advancement in areas like EVs, for example, is also causing some companies to scale back investment in China. And at the same time, on the flip side, you have the domestic Chinese companies sending record amounts of money abroad as well, over $71 billion in the second quarter, up 80% from the previous, from the same period last year as well. Again, reflecting, the need to find new markets overseas outside of China.
With China correspondent Min Lo there. And it's time now for morning calls ahead of the Asia trading day. Goldman Sachs trading desk sees a brief window for investors to buy the dip in U.S. stocks. Tactical specialist Scott Robner says he's turning bullish on U.S. equities at the end of the month as selling pressure from systematic funds eases. Morgan Stanley now says a double whammy of economic uncertainty and a weak period for corporate earnings forecasts is likely to cap stock market gains in the third quarter. Strategist Michael Wilson expects the S&P 500 to trade in a range of 5,000 to 5,400 points as macroeconomic data flash no clear signs over the short term. We have more to come. This is Bloomberg.
Take a look at commodities that we're watching so far. Of course, oil seeing some of that strong gain on these expectations of the reprisal from Iran, creating potentially more conflict within that Middle East region. Of course, on Sunday, Tehran saying, really reiterating their call that they're still determined to punish Israel. We have seen WTI also, when it comes to that sort of algorithmic trend, going above that 200-day moving average, and that sort of spurred some of that buying there as well. Also watching some of the other major commodities trading and seeing the price action when it comes to coffee as well. Big jump there, the most in about 5 weeks, and we've seen some more data out of Brazil as well, supporting that 3.6% higher is where coffee is trading at the moment. Watching iron ore traded in Singapore, a jump of about 1.25% as we see potentially a little bit more upside in terms of expectations of policy moves from Beijing. But of course, we have seen some recent fluctuations and more recently more of a retreat for iron ore. Copper, though, still up by 1.8%. Well, we're also in really the middle of Aussie's earnings season, and CSL will be one to watch at the Open. It released full-year results a short time ago. The pharma giant reporting a 20% increase in full-year net profit. It's forecasting further growth going into 2025. Paul Allen joins us now with some of the details. So, from the outset, not entirely bad numbers.
Yeah, pretty good set of numbers for the year. 2.64 billion, as you say. That's a 20% increase in net profit. Revenue up 11% as well, and the dividend, $1.45, a big improvement on the $1.29 from last year. CSL's got three main businesses. One of them is Behring, which is the main business, deals with blood plasma for therapies. Costs of collection of that were being closely watched, but they've continued to decline per litre, both in terms of compensation and labour costs as well. Seqirus, which we all know from the COVID periods, make vaccines. That's very closely watched also. The CSL says conditions there remain challenging. Revenue, though, still narrowly beat estimates. And Vifor's, the third business, focuses on iron-based therapies. And that continues to grow volume. But CSL says they do have competitors in Europe from generic brands as well. But that all said, the outlook pretty good. Sees profit rising another 10 to 13% in the coming year. Forecast of 3.2 billion, and analysts like the stock as well. 13 buys on that and 0 sells.
Well, Alan here in Sydney with us. CSL one to watch, of course, in about half an hour's time when that stock comes online. But traders are bracing broadly for further declines here in Australia on expectations of some weakness across earnings compared to their Asian peers. Let's get from Karen Jorritsma, head of Australian equities, I should say, at RBC Capital Markets, a bit more insight. Karen, great to have you with us. So the revision down is about 4% over the past year compared to broadly gains that we've seen across the rest of the region. Why the weakness, particularly at a time when we see Australian equities still trading pretty close to record highs?
It's a really curious point you make around Aussie equities being near their high. I think we're seeing a bit of a revenue slowdown across the board, and that is in line with what the RBA really is looking for. They are trying to take the heat out of the economy from an inflationary perspective. So the concern I think we have heading into reporting season, though, is around margins, insofar as we're seeing higher cost growth than revenue growth. So I think that's what we have to get our head around this reporting season.
And I know you've got some picks, but I wanted to get your view on financials too, because CBA is a big one that we're watching. Do you expect that these numbers will kind of equal the justification for how high these valuations are for financials?
Well, that's a great point, because if you look at the analyst calls, they're all for sells across most of the major banks now on valuation basis, and certainly from a fair value perspective, the banks are trading in excess of that. I think the issue is, though, that the banks are continuing to perform very well, and there's no signs of cracks in any of their businesses or their books. So we're actually seeing what is a really good outcome for the banks at the moment. So in a market where it's hard to find great stocks that you feel safe in, I think the banks have tended to be a bit of a safety trade.
What are you opportunistic about, particularly, I guess, in the sort of environment of perhaps a renewed heightened sense of caution given the events of just a week ago?
Yeah, look, I think any of the names that have those good recurring revenues, so some of the tech names, we always like NextDC for that reason. They've got great leverage to that AI thematic and the data centre thematic, which continues to grow. Goodman Group for the same reason. I think the banks do offer that safety trade insofar as you're getting a great dividend, and that's what a lot of the Aussie market's looking for, is that yield and that return. So I think that will continue to appeal to people. And then I think the dividend names continue to come back into play, like with yields globally falling, the yield trade in Australia continues to be very strong. So I think that will come back into focus.
Karen, we're also getting Australian wage data today, not to mention jobs data later in the week as well. We have seen pretty solid numbers and a very hawkish RBA so far. What are we seeing in terms of consumer sentiment when you have also interest rates at really high levels?
I think the consumer is going to be the really interesting piece for this round, because we have had a lot of negative sentiment, and certainly there's been a lot of press reports about the consumer being under pressure. However, what we are seeing is the results coming through, and JB Hi-Fi yesterday was a great example of that. The consumer actually seemed to have done a little bit better in July, certainly from the JB Hi-Fi perspective. Temple and Webster this morning suggesting that the consumer is also far from broken. So it seems to me that the consumer has pockets of ability to spend and are continuing to do so. So it feels like things are going better than we probably think at this stage.
Are you seeing anything from the American earnings season that could potentially impact what's happening in Australia and perhaps some of those companies that have close relationships with global markets?
Yeah, look, the takeaway we took from the US earnings season was that the sentiment was largely neutral, which I think was a positive. The C-suite commentary was very centred around, some uncertainty, certainly from a growth perspective, and there were definitely concerns around China, but broadly that the consumer's cautiously optimistic. And I think the C-suite in the US felt similar to what the Australian C-suite is discussing, which the balance sheets are in very good shape and that they feel very comfortable about the business outlook for now. So at the moment, I think we're sort of neutral to positive to slightly positive would be my takeaway.
When it comes to the macroeconomic picture around the world, there are expectations right now for a weaker U.S. dollar given potential rate cuts coming from the Fed. How does this factor into the earnings outlook for these Australian companies?
Yeah, there's a couple of Australian names that are definitely exposed to the US and the US economy, and then, of course, the currency measures. So that could be slightly better for some of the Aussie names if the US dollar reverses a little bit. But the flip side of that is other outcomes. So I think at this stage, we're not particularly expecting the US dollar moves in a material fashion, to be honest. I think at the moment we've got a situation where the Fed is being very closely watched. I think the outcomes from the Fed of a couple of rate cuts are already well priced into the market. And then what happens in Australia is very uncertain. So that's going to have a very large impact on the currency going forward.
Still a lot of uncertainty around China as well. Are you sort of avoiding or looking a little bit more closely at some of the companies that have exposure to the market? There's
been a very difficult space for resources. That's clearly a very big driver for the resources sector. And I think that if you look at the short list in Australia at the moment, very heavily focused on a lot of the smaller resource names, and that's because of that China uncertainty. I think that will continue. We are going to be watching for comments in that regard.
It'll also be in sort of intertwined with the uncertainty with the US and the political outcomes too, right? Karen, really great to have you with us. Karen Jorritsma, head of Australian equities at RBC Capital Markets. Shery.
And Haidi, these are some of the other corporate stories that we're watching at this point. Bloomberg has learned Johnson & Johnson cleared the key hurdle in its $6.5 billion plan to resolve thousands of lawsuits by people saying its baby powder gave them cancer. Sources say more than 75% of the group signed off on the company's settlement offer through secret balloting. The result would help J&J's efforts to contain liability to a unit it set up to resolve the lawsuits. The litigation is ongoing. A Bloomberg analysis of government data shows U.S. retailers, including Walmart and Target, are selling generic versions of the cold medicine Mucinex that contain a cancer-causing chemical, benzene. The chemical is unlisted, found inside a cheaper version of an inactive ingredient in the store brand option. U.S. regulators have ordered the ingredient phased out, but the deadline has been pushed to 2026 after industry complaints. BHP Group is ramping up efforts to avoid a strike at the world's biggest copper mine. The company says it presented a new wage offer to union leaders in Chile, which includes a nearly $30,000 signing bonus and improved benefits. Failure to get the union's approval would set up a stoppage at BHP's Escondida mine, which accounts for about 5% of all the world's mined copper. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how we're setting up for the opens here in Japan. Of course, Japan was away on holiday on the Monday session, but we're coming back today. And futures right now looking to the upside. Nikkei futures up 0.7%, while we're seeing a little bit of strengthening for the Japanese yen, but still at that 147 level. Investors really got spooked by the yen carry trade blow up that we saw last week. They pulled cash from a Japan-focused stock ETF that strips out moves in the country's currency. For more, senior Asia stocks reporter Hideyuki Sano joins us now. So what exactly are investors doing? I mean, it was such a roller coaster ride last week.
Exactly. This currency hedged ETFs have been very popular, and that is because even though Japanese share prices have been rising earlier this year, the yen was weakening almost constantly. So foreign investors have been losing at least that forex portion, even if the yen-denominated stock prices are rising. So they had this nice strategy to hedge the currency exposure a bit, and that had extra bonus in terms of return, because if you hedge the currency exposure, dollar-based investors could get something like 4 to 5% extra on top of dividend yield. So effective yield was almost like 8%. So that did look very attractive trade. Of course, that until things changed suddenly this month when Japanese stock prices were, fell like 20% and became the worst performer.
Monday was such a bloodbath, wasn't it? I mean, we were really not expecting that to happen, and then we had gains again on the Nikkei and the topics. And did we have a bet last week whether we were ending up or down for the week in Japanese stocks? Did we end down a little bit?
Yes, it was down a little bit, and but it's still getting close to recovering all the losses made on last Monday. Some people call Tokyo Black Monday. But we'll have to see. I mean, a lot depends on the yen's exchange rate, I suppose.
Yeah, almost last week felt like a little bit of a blip, didn't it? After all of the incredible moves that we saw in the markets up and down. But eventually, we will have to see what happens with the yen if the U.S. starts cutting rates, right?
Yeah.
What are the expectations right now for the yen? Because I'm seeing these calls that range from 100 to 160. I really don't know where to stand here.
Well, I guess that is a good representation of what's going on in the market at the moment. I mean, people are really confused. Some people think the market could quickly go back to the status quo, whereas other things, the yen could strengthen further. I mean, it's obviously almost impossible to tell where the yen is going, but if you look at one good indicator, which is speculators' net yen short positions, they had built up massive yen short positions earlier this year. Now they are almost gone. So I would think it's fair to say basically these huge speculative positions in the yen are already gone. So the market is almost like neutral at the moment.
In a way, did the BOJ sort of achieve what it was hoping to achieve, taking the froth out of the markets, taking the speculators out of the markets, and will the yen move based more on fundamentals now?
I would assume so. I mean, basically, probably, this yen weakening has been built on speculation that yen's interest rate will stay low forever. And that was basically rolled back. So probably the market will focus on fundamentals, which is like U.S. inflation, or whether how much the U.S. economy is going to slow down. I mean, that's probably the most important questions at the moment.
So Heidi, just get ready for that inflation picture from the U.S. this week, right? CPI, PPI coming up.
Feels like we're just bracing for every incremental data point at this point, given the elevated levels of caution, right? Our senior Asia stock reporter, Hideyuki Sano, there. I don't think I was part of that bet. Probably just as well. I probably would have lost. Oaktree Capital Co. CEO Armin Panasian is warning that the upside potential of artificial intelligence may also come with devastating consequences. He discusses these major factors weighing in on the booming industry in the latest edition of Bloomberg's Next Big Risk.
The biggest risk that I see with respect to the markets and to society in particular is artificial intelligence. Artificial intelligence clearly has the potential for very large economic gains, revenue increases, cost efficiencies, and that investment opportunity is really exciting. It's easy to disregard the societal impacts of those same efficiency gains. What happens to normal jobs that are become obsolete because of artificial intelligence? Think of cashiers or drivers. As artificial intelligence becomes a real alternative to physical labor in some of those areas, millions of people could be out of jobs. So who's going to retrain those people? Because if we don't figure that out, that there will be social unrest, or there could be social unrest because of joblessness. In terms of the markets, artificial intelligence clearly is getting a lot of support from the markets. But just like the internet in the late 90s, there was this promise of revenues growing rapidly. While the gains are clear to see in terms of their potential, the timing of them is impossible enough. And if that timing takes a lot longer than investors expect, I would expect to see pretty violent resetting valuations and potentially some losses for investors along the way.
What does this look like for an investor who's keeping a close eye on the economy, the job market, let alone investing in AI itself? It seems like the risk you're outlining here could impact many markets.
The attractive part of it and the scary part of it is that there isn't a monopoly on intellect that could be used to develop artificial intelligence technologies. There is a shortage of semiconductors and chips, but artificial intelligence allows economies and countries, and potentially those adverse to the U.S., to develop certain technologies and skills through artificial intelligence that could be problematic from a geopolitical standpoint. In terms of what investors should be looking at from the economy, it's hard to really have a leading indicator. I think, unfortunately, from the job market perspective, we're going to be looking in the rearview mirror probably after it's too late. So it's really hard to kind of pinpoint what economic indicators we should be looking for specifically.
How do you think about this in terms of how people are behaving right now? Do you think most investors out there are ignoring these risks?
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Oaktree co-CEO Armin Panosian speaking with our colleague Shanali Basak on the next big risk. You can catch the full episode now on the terminal, Bloomberg.com, or on YouTube as well. We have more ahead on the Asia Trade. This is Bloomberg. We have breaking news out of Japan. We are getting the PPI numbers for the month of July. Here, year-on-year growth of 3%, which is missing to the downside from economists' estimates, but still is an acceleration from the previous month. Month-on-month is also gains of 0.3% for the month of July, meeting expectations and also accelerating from the previous month. Of course, we have seen the BOJ trying to really push up inflationary impulses here in the Japanese economy, and a weaker Japanese yen also helping with that number. Remember, the July PPI number year-on-year coming in at 3% growth is also at a time when the Japanese yen had really touched that 161 level, really decades low against the U.S. dollar, Haidi. And of course, we have seen those inflationary impulses being heightened by a weaker Japanese yen. Now we're sitting at that 147 level.
Yeah, and of course, a lot of people still watching for what further wash-up we're going to see with the unwinding of the yen carry trade as well. In the meantime, of course, we're very much focused as we head into the November presidential election in the US, and former President Donald Trump appears to be back on the social media platform X ahead of his interview with the network's owner, Elon Musk. Our politics reporter, Adriana Lowenkron, joins us now for more from Washington. Adriana, we're sort of almost bracing for this conversation, right, given that we know both of these individuals anything could potentially go and be said.
Absolutely. Anything and everything could happen. Anything could be discussed. We over here are looking for whether there's going to be some talk about EVs, electric vehicles. We know that Musk has really not kind of been super involved in the political sphere as of a couple months ago, but now we know that he is supporting kind of a PAC that has been backing Trump. We know that the two of them have talked in terms of crypto, in terms of EVs. So those are some policy things that we're really looking out for.
And we know that Donald Trump has had a very chaotic few weeks, especially as he tries to regain people's attention after Vice President Kamala Harris threw her hat in the ring. Where are we at right now?
Absolutely. This is definitely a more non-traditional or unconventional approach to campaigning. In the past week or so, Trump has really laid low in terms of not being on the campaign trail as much. He did, of course, just have a rally in Montana, which, as you may know, is not a traditional swing state. But he was there to kind of focus on some down ballot stuff. There is a congressional race there. He will be going to North Carolina on Wednesday and then Pennsylvania later this weekend. So he is kind of ramping things up. But the past week, things have really been, there's been a bit of a lull for him. Instead, he has been having these types of interviews. He had one, or conversations, as we call it. He had one with a video gamer a couple of days ago. And so, again, he is really trying to turn the attention back on him. There has been a surge in momentum with the Harris campaign. And again, this is, just trying to kind of change that narrative, bring their attention back on him. And we'll see what happens tonight. Of course, we're keeping an eye out for even if there are going to be technical difficulties. That was something that happened the last time there was kind of a Musk candidate with Florida Governor Ron DeSantis a year ago. So we're ready for that as well.
Politics reporter Hadriana Lowenkron there with what we can expect perhaps from that conversation between Elon Musk and Donald Trump. Let's now take a look at how markets are trading right now because, of course, we're headed towards Japan, Korea, and Australia opens at a time when the Japanese equity markets are coming back after a holiday. Right now, we're looking at gains in the future space of more than 1%, a little bit muted when it comes to futures elsewhere. Of course, we have perhaps a little bit more catch up to do in Japan after we saw gains across Asia on the Monday session. We are, of course, coming back after an incredible week of volatility, $1.1 trillion in market value actually being erased in the Japanese markets with a 3-day loss just to make a huge comeback and then really end up pretty much flat, a little bit down for the week in Japanese markets. It's all to do with where the Japanese yen is going from here. We're still at around the 147 level against the U.S. dollar. A little bit of weakness that we're seeing. Of course, we have seen a little bit of a resurgence in the dollar lately with geopolitical concerns also rising. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And of course, Jerry, the focus is really watching Japan very closely. Of course, it was a long weekend. We're getting that sort of first reaction as we're seeing that semblance of caution really returning to most global markets, awaiting, of course, US CPI numbers. We did just get Japan inflation numbers, kind of still painting the same picture of progress when it comes to the reflationary effort.
Yeah, 3% gains when it comes for the month of July year-on-year for those producer price numbers in Japan. But you said it, we also have PPI, CPI out of the U.S., not to mention, of course, geopolitical developments that we're watching around the world, around Ukraine, around Israel as well.
That's right, and all this could feed into inflation pressure as well, right? We're seeing oil looking pretty buoyant at this point. We did hear from Taiwan over the weekend, of course, saying that they are still intending to really seek reprisal against Israel. We do have some breaking news just crossing the Bloomberg when it comes to Singapore growth numbers. This is what we're looking at when it comes to the island state. At the GDP, the second quarter GDP number seeing a rise of 0.4% quarter on quarter. The estimate was for 0.2%. That is a little bit stronger than expected. The second quarter final GDP rising 2.9% year on year, also a bit stronger than the 2.7% that was expected. They have, though, narrowed their 2024 GDP growth estimate to 2% from the 3% range. The estimate from the initial 1 to 3% range has been narrowed there as well. So seeing certainly some degree of caution when it comes to expectations of forward-looking growth. And of course, we know that Singapore in a lot of ways is that sort of canary in the coal mine, being very externally exposed, very trade dependent and very internationally exposed market there as well. We're seeing just that sort of modest revision lower of expectations for GDP growth, Shery, for 2024.
We are also expecting GDP numbers out of Japan later in the week, but take a look at how we're coming online for the Japanese session. We're seeing gains of more than 1% for both the Nikkei and the Topics, a little bit of a catch up given that, of course, Japanese markets were away on holiday. Remember that incredible volatility that we're coming from last week. I mean, we lost more than $1 trillion in market value in Japanese stocks in the course of 3 sessions just in order to regain it all back and sort of end the week with a little bit of a blip downside for 4 consecutive weeks. But it's all to do with the Japanese yen, right? I mean, we're seeing a little bit of strength against the U.S. dollar at this point, but we're still at that 147 level, and a lot of caution at the moment where how far the carry unwind has gone and if there is more to go. What we're watching also is the bond space, because we saw treasuries really gaining ground in the overnight session given those geopolitical tensions that I just mentioned earlier in the show, whether it's on the ongoing war in Ukraine or what's happening around Israel. Remember, Fitch just downgraded Israel to A, given the expenses and related costs on the military activities in the region. But energy shares is something that we'll be watching in today's session as well. Take a look at how the Kospi is coming online, because it saw a really strong session on Monday. We are seeing some gains for the Kospi, up 0.5%. The Korean won holding steady at that 1370 level. Of course, it's also to do with more resurgence dollar strength lately, given that haven demand as well, Heidi.
Yeah, take a look, Shery. Of course, we're in the thick of sort of earnings season expectations for Australia, and these expectations are, to be fair, quite low, given the revision lower of about 4% over the past year compared to the rise that we've seen across other regional markets. So certainly watching for the likes of CBA this week. That'll be major when it comes to Australian financials. But, you know, as our previous guest had said, still a lot of appeal when it comes to these financials purely as a dividend play. We're seeing a little bit of softness there going into the start of trading for the ASX, off by about 1/10 of 1%. Watching CSL as they come online there as one of the earnings sort of stories that has come through. Pretty robust numbers overall there. The Aussie dollar is looking very flat at the moment, and of course we're also watching treasuries as we see kind of the volatility and of course the sort of return of caution there. We saw aggressive Fed cut rate bets drawing quite a bit of demand when it comes to the 3-month bill auction there as well, but also that gain in treasuries again being revived given the escalation that we see in the threat of geopolitics in the Middle East as well, Shery.
Yeah, Heidi, let's now discuss the market opens, of course, with Japan coming online from the long weekend as well. With us now is Daniel Lam, head of equity strategy at Standard Chartered Wealth Solutions. Daniel, great to have you with us. We're seeing this morning how the yen-hedged ETF suffered this exodus of cash given the unwind in the yen carry trade as well. Are we going to see a rethinking of the Japanese strategy if before last week it was all about, you know, positivity and this ongoing rally?
Well, like you said earlier in the show, is really right now it's all about the dollar yen. Okay, so we do have heavyweight figures coming up in the US CPI. So we're already seeing the latest Japanese inflation number is, you know, pointing towards further tightening, right? So the US CPI is going to be critical because it's the other side of the dollar yen equation. Now, right now, I believe we're walking a very narrow line there for tomorrow's CPI release. That's because if the CPI were to be lower than expected, then investors would think that, you know, the growth in the US is slowing down, you know, perhaps faster than what we're expecting. And then you could see another round of unwind of this carry trade, right? Because I don't believe it's done yet. But if you see that the inflation number is higher than expected in the US, then people are going to say that, oh, the Fed may not have such room to cut rates to support the growth. So you could get another risk off. So really, you need to be hitting that small, fine range in the US CPI in order for the market to be doing okay.
Yeah, I mean, options are now showing that we could see moves of more than 1% either way on the S&P 500, given what happens with the CPI numbers. Is volatility just what's certain at this point, given that we really don't know how these economic numbers will come out? And if that's the case, how do you hedge?
Well, that's the reason why investors are going for the U.S. Treasuries, right? Given what's going on in the carry trade saga, and given what's happening in the Middle East, for example. So we do see that actually, if the U.S. 10-year government bond yield is still around 4%, that's actually a good level to add, because the trend is for the Fed to be cutting rates, right, regardless. So usually, if you have this rate cutting cycle, the U.S. 10-year yield will be coming off gradually anyway. So locking in this 4% yield for the longer term is actually not a bad idea.
Daniel, one of the sort of stories that emerged out of the sell-off was perhaps that China, again, in this situation, can be that kind of counter-cyclical hedge, if you will. Does that narrative sort of appeal to you? Do you find any sort of opportunistic value looking at China at the moment?
Yes, so actually we've seen that the Hang Seng Index has been relatively unscathed from this, right, from the last week. So it is a reasonable trade for investors to be looking for a safe haven for the short term. In China, we are looking at the high dividend yielding stocks, the SOEs that are high dividend yielding. So those will have the government policy supporting them and also have the yield going for them. So they're relatively defensive.
Daniel, if you take a look at sort of the landscape as we head into the rest of the year, do we just assume that further volatility is almost inevitable, particularly as we get into the uncertainties around the US election? Where would you be seeing opportunities within Asia that perhaps are a little bit more shielded from that?
Well, in Asia, given the volatility, the high dividend yielding stocks, the SOE high dividend yielding stocks in China, they should be the ones that people should be looking for. But in terms of the US equities, right now we're seeing volatility, and probably the unwind has not been done yet for the carry trade. So you could see another leg down in US and also in Japan equities. But then there will come a point where they become attractive. The earnings in the two markets is still very much robust. And also the fact that the growth stories in the AI side of things, they also remains very well, right? So after this another leg down, there could be some good opportunities in the US tech space, for example.
Daniel Lam, Head of Equity Strategy at Standard Chartered Wealth Solutions there. Take a look at some of the early movers that we're watching. CSL, of course, amidst Aussie earnings season. We had some pretty decent numbers out from the Australian pharmaceutical giant, but we are seeing downside of about 2.7% there. We're also watching, of course, the reopen after the long weekend of trading in Tokyo. Sharp is one of the biggest laggards, down by just about 5.5%. The first quarter operating loss at play there. 5.8 billion yen was the loss against an estimate of 3.25 billion yen. That came out after the bell on Friday, so really the market's first chance to react to those numbers. Isetan Mitsukoshi also there at play, modestly higher after a boosted full-year operating income view and also beat estimates there as there. And Rakuten, we're watching up by almost 7% in the early parts of the trading session. Second quarter operating loss of just over 18 billion yen. That was actually worse than expectations there as well, but we are seeing a positive reaction when it comes to Rakuten Group trading more broadly. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Asian sovereign bonds are trading at the moment. We're seeing gains across the board as, of course, we have been seeing U.S. Treasuries rebound in the overnight session. A little bit of haven demand given escalating Middle East risks. Right now, the 10-year yield, though, holding steady below that 0.9% level. And, of course, we've been watching the bond space in China as well, given more news about Beijing trying to cool that ongoing bond market rally, with sources now telling us that regulators have told banks in Jiangxi province not to settle their purchases of government bonds. Of course, this also gives concerns to the integrity of the market in China. But so far, we will continue to watch if that bond market rally continues, because in the previous session, we saw it plummet by the most since 2023. The 10-year yield still below that 4% level. Now, let's talk a little bit more about that story on China, because regulators are set to be taking those very extreme measures to try to cool that bond market rally. Let's bring in Min Lo, who's our correspondent on China from Hong Kong. So what exactly is going on here?
Yeah, so we have several rural banks in eastern Jiangxi province that have failed to settle their transactions on Monday, which, as you said, it is something that could undermine market integrity if the counterparties start to worry about more failed transactions in the future. This is after authorities told those banks to stop purchasing government bonds. And we understand that the officials had initially rescinded that order before then reinstating it again, which suggests that there is some level of perhaps chaos or confusion or a struggle by authorities to find the right balance to intervene in that bond market. And this also comes after Bloomberg learned that at least 4 brokerages have now cut down on bond trading as well. Most of them are saying that it's a voluntary move, but at least one is saying that they are taking guidance from the authorities. And yesterday as well, state banks were selling 100 million yuan batches of the 7-year note. So many measures kind of moving in tandem here, and that's why we saw the 10-year bond yield go up 4 basis points yesterday. 2.24% is the highest we've seen in 3 weeks, and at the same time, the volume of transactions have come down as well by 45% compared to the high that we saw last week on Tuesday. The big question is, how long can this reversal of that bond rally last?
Certainly this sort of regulatory action doesn't create a great deal of confidence amongst foreign investors, right? They've also pulled a record amount of money out of China in the last quarter.
Yes, $15 billion to be exact, and that is the second time that we are seeing a negative print on that number. In the first half of the year, investors pulled out $5 billion from the Chinese economy, and if this trend continues, we could see the first time that China sees an annual net outflow of investment, at least since that data became available. And this comes amid geopolitical headwinds, perhaps companies cutting down their exposure to China, and you have the weak domestic economy as well. China's surprise advancement in areas like EVs have caused some companies to scale back investment in China. And at the same time, your domestic Chinese companies are sending record amounts overseas as well, $71 billion in the second quarter, up 80% from the same period last year. And this reflects the need for local companies to find overseas market amid that consumption slump within China, and also hedging some of that geopolitical risk by investing in plants and factories overseas as well. And of course, you have the interest rate differentials as well that makes more sense for MNCs to keep their money out of China rather than in China.
Min Lo, our Bloomberg China correspondent there with the latest. Take a look at what we're seeing across markets. And interestingly, we're seeing this sort of semblance of risk returning to trading today. In fact, when it comes to the MSCI Asia Pacific Index more broadly, it's now trading at a level seen before that August 5th rout. And we are seeing a little bit more positivity, but of course that caution ahead of US CPI and PPI, as well as Japan returning to trading today after the long weekend. Really, we're still looking for a few more cues. Risk appetite appetite wasn't also necessarily that hefty in the overnight session either. We had a lot of geopolitical risks to contend with, and a lot of those are still unresolved as well. But at the moment, we are seeing broad gains when it comes to some of these markets, with the MSCI Asia Pacific Index trading now back at the level seen before that August 5th rout, or, as we refer to as the Black Monday in the Tokyo session. Let's take a look at what we're seeing when it comes to currencies trading, though. Of course, let's bring in our FX and rates reporter, Michael Wilson. So, of course, US CPI, PPI will be, front and centre. What are we looking for in terms of the FX reaction?
Well, I think there was a little bit of evidence last night where the focus was just taken away from the CPI print. Everyone's been talking about it, but they had a little bit of a curveball to deal with, and what it did do, it just flushed out the positioning a bit. And I think that you've seen there maybe the dollar as a haven probably relegated to third place behind the Swissy and the yen, especially given that dynamic where, the divergence between risk of a potential BOJ hike, and you've got 50 points thereabouts baked into the Fed in September. So if you're going to go for a haven, you're probably going to have in the back of your mind also, you might have to have that haven for a little while that Iranian situation plays out. So obviously the dollar wasn't the preferred one. Dollar yen came off its highs pretty quickly, and as did stocks, and oil jumping up like it did above $80 a barrel. Ordinarily that would be a negative for yen, but the markets looked through that as well, and they just went and maybe a little bit of position unwind that had just been taken on in the wake of what Bauman said and what ex-BOJ officials said. But I think the traders, by and large, this is a bit of a no man's land, and they probably look for a little bit of a extension, either post CPI. If it was a hot CPI print that pushed dollar yen up near, say, towards 150, they would certainly try and fade that, try and sell dollars and buy yen. Conversely, if it was, if the yen, as a haven became overbought, for the want of a better word, too far too soon, they might try and sell some yen on a dip, towards that, I think we hyperextended to that 140, 170. So anything below 144, I think they'd probably start to short the yen again and try and trade the range, as it were, until the thematic, where the Fed gets underway with its easing cycle, and we get a bit more consistency out of either central bank at this stage.
It's interesting that we're starting to see that haven appeal come back for the yen versus even some of the other traditional havens.
Yes, that's a good point, and people are talking about it. They ordinarily wouldn't be the go-to thing. Hasn't been spoken of as a haven for a while now, but with all the carry story, by and large, in the price, as it were, and the position unwind largely done. You can treat it for what it is, and you don't get those because of the positions have been unwound like they have. Buying into the yen in a haven scenario, you won't get that wild, volatile look. There's a fair chance that it may be either in your favour or about where you entered. Compared to what it had too many other things to consider or deal with before. So I think that going forward, they're moving that second aircraft carrier into position as fast as possible. The CPI print, it's going to dominate things, I think, but I think the shelf life might be a little bit shortened for what it could be, because if that Iranian situation really does heat up, oil goes north of $85, and it will bring volatility back in the market. And so if that backdrop there is still there, for the Fed, well then I think that yen could probably benefit a lot out of the next 48 hours.
And Michael, we're also seeing bonds, sovereign bonds across Asia following treasuries higher right now in the Asian session. Are we going to see bonds also act more as a haven trade going forward?
I think that's where the money will end up. I think that they're torn between the hunt for yield and just somewhere safe. Now, Asia is not the Middle East. You're far enough away from it geopolitically. You're going to get a half decent yield, and liquidity is improving all the time. So the Asia markets, what they were 5 years ago to what they are today, they're getting a lot more. They're behaving a lot more like developed markets. So, it's not a surprise to see an attraction of funds into Asia as by way of maybe waiting this one out and seeing how for the volatility to settle, and that'll probably like a little bit of a premium on Asian bonds, if you like, because we are a fair way away from the drama, and we do offer an attractive yield relative. So, I think that will they outperform Treasuries? Well, that's probably the main question. I'm not sure about that last one. I'm not too much of a rates guy, but I think on a liquidity basis, I'd probably favour Treasuries over the EM.
Michael Wilson, good to have you with us, FX and rates reporter there with his take on what's happening in the markets right now as we're watching the MSCI Asia Pacific Index gain ground and sort of almost erase all of those losses that we saw from the Monday rout. We're talking about being back around levels before that August 5th Black Monday here in the Tokyo session. We, of course, have seen 3 days of gains for MSCI Asia Pacific. But really a lot to do with what's happening in the Japanese market, because the Nikkei is rallying 2%, the Topix is up 1.5%. You take a look at MSCI Asia Pacific without Japan, and you can see right there, really nothing is happening. In fact, we're seeing a little bit of downside. More ahead on the Asia trade. This is Bloomberg.
Let's get you to some of the market calls that we're following today. And Goldman Sachs trading desk sees a brief window for investors to buy the dip in US stocks. Tactical specialist Scott Ribner says he's turning bullish on US equities at the end of the month as selling pressure from systematic funds eases. He says the August to September corporate repurchase window is historically strong. Ribner back in June told clients to trim their exposure to US stocks. Morgan Stanley says a double whammy of economic uncertainty and a weak period for corporate earnings forecasts is likely to cap stock market gains in the third quarter. Strategist Michael Wilson expects the S&P 500 to trade in a range of 5,000 to 5,400 points as macroeconomic data flash no clear signals over the short term. The upper end of that range implies gains of just 1% from current levels. The lower end would mean a decline of over 6%. We are actually seeing quite a bit of buoyancy when it comes to trading here in Asia, though, with of course, the MSCI Asia Pacific now at levels before August 5th. All right, let's get you the latest data just crossing the Bloomberg when it comes to the Westpac consumer confidence numbers for Australia. And of course, a lot watching on sort of incremental data points coming out from Australia, given the implications for the RBA. And given, of course, we have seen that weakness across households, retail spending amidst the cost of living crisis. Westpac consumer confidence rising 2.8% month on month, rising to, in fact, 85 on that level. And so perhaps really seeing a little bit more of an improvement, given that we have seen sort of expectations that perhaps the RBA is getting close to the end of its hiking cycle, although that sort of hawkish hold, of course, has still been maintained in the most recent commentary. We are seeing a little bit of flat trading there when it comes to Aussie stocks. We do see, though, broadly speaking, across the Asia Pacific, the MSCI Asia Pacific seeing levels now sort of back to before we had that August 5th rout. And of course, part of that is interesting, given that overnight we were very much preoccupied by the story of geopolitical risk, Shery.
Yeah, I mean, we saw oil prices really spiking. We're still watching energy shares. The U.S. now believes an Iranian attack against Israel may come as soon as this week as leaders continue to work to de-escalate tensions in the region. Asia senior editor Bill Ferries joins us now with the latest. And Bill, we have seen the U.S. really building up its presence there.
That's right. We've seen the U.S. has told its aircraft carrier, the USS Abraham Lincoln, which was in the Pacific, to accelerate its progress towards the Middle East. And we've also found out that the U.S. is deploying the USS Georgia. That's a submarine that carries Tomahawk missiles that are often used in attacks on land sites. And the U.S. doesn't typically announce the movements of its submarine fleet. So it's an unusual announcement and a clear warning against Iran and its proxies against further action.
Bill, we're of course getting into more pressure into ceasefire talks. How realistically optimistic, can we be about this situation, given that we've seen, really an unwillingness on either side to kind of discontinue what they're doing so far? Not to mention the key negotiator for Hamas was killed in the attack in Tehran.
Yeah, I mean, we've been talking about these peace negotiations for 4 or 5 months now in terms of this latest round. And we've heard consistently that both sides saying that, they're very close to an agreement, but there's a few final sticking points. Those final sticking points have been really problematic so far. There is some effort among the negotiators to try to use this risk of heightened retaliation from Iran and the possible breakout of more conflict between Iran and Israel as a way to try to push through talks. They're saying that August 15th is the next set of planned talks here. It's still not clear whether that will go on, if there's some sort of an Iranian counterstrike on Israel in between now and then. So it's a very tense situation. You saw that with the oil price climb yesterday. And while we've been saying that an attack is likely for over a week now, the wording, what we're hearing from U.S. officials seems like that risk has climbed in the last day or so.
Bill, we're also watching developments in Russia's Kursk border region. It was interesting. We saw Vladimir Putin cutting off a governor who was talking about the Ukrainian side having taken control of a number of these borders in that towns in that region. What does this incursion potentially mean for the Ukrainian war effort?
Well, it means that the front has probably broadened quite a bit. It's clear that Russia was not prepared for this kind of action, and it's probably Ukraine's biggest success in terms of countering Russia since early 2023, when it took back some of the territory it lost early in the war. It's thrown Russia on the back foot. Anytime you have a situation where you have over 100,000 people being forced out of the region they live in, it's going to be seen as a big setback for Putin and his defense ministry and his military. The question is, does it turn into a much broader fight across the entire front? And is Russia able to quickly counterstrike and push the Ukrainian forces out?
Our Asia Senior Editor Bill Ferry is there with the latest, and of course all of this is playing out when it comes to the upside momentum we're seeing across crude prices. Let's talk about the broader picture when it comes to oil demand. The outlook, bringing Mukesh Sahdev, who's a head of oil trading and downstream at Rystad Energy. Mukesh, great to have you with us. There is a lot going on when it comes to the sort of potential disruptions to energy. What are you sort of most focused on at the moment?
Good to be back on the show, Haidi. I think I'll break it down into 3 parts, right? I think there is a lot of focus on geopolitics, macroeconomics, and what I would say is that we blow hot, we blow cold, and we are just one data print away. We had a data print on U.S. jobs, and that affected the market. Then there is another good data point and draws in the U.S. crude stocks that lifts the market. So I would say that macroeconomics and geopolitics is probably not playing a huge part as people think. Then the second point, I believe, is on the crude market side, crude fundamental side. And I would say that kind of the OPEC math is tough math, and I would call it is a bit of an opaque math. We believe from our analysis that the oil which is probably coming into the market is more than what's getting counted. We live in a world of what I call caps, cuts, and quotas and sanctions. So that's not the market efficient way. So there is more oil probably leaking. And the third point I would say, which probably gets ignored a lot, is that Middle East has gained a huge downstream refining strength over the last few years when they have built a 2 million barrel plus refining capacity. And they're pumping almost 1.5 to 1 million barrels more products to the market. So I guess that within these two parameters, the market stayed supplied and the oil prices kind of stay and hang in the 80s. That's what I would say the market is doing.
So I'm glad you mentioned OPEC, because obviously they've cut their demand sort of outlook before they make their next decision. Does that, given that you suspect there's more supply, does that demand outlook still look optimistic?
Well, I think that's an excellent question. I would say OPEC has been keeping its oil growth demand outlook at 2.25 for the last 12 prints, right? This time, I guess, they had to make some symbolic marginal correction from an yearly growth number of 2.45 to 2.1. I believe that they have just started lowering the demand outlook, and probably it will continue to lower as we go along the year. Our belief is that the oil demand growth is probably going to close by 1 million barrels per day. And we have been quite steady on our numbers. And quite a lot of that growth is probably still going to come from China. I was in China last few weeks, and I would say that Beijing is buzzing. And probably the demand narrative that comes out of China is likely a little bit overhyped or overblown. So 1 million barrels per day demand growth this year sounds good to me. 2.5, I would say 2.1 is really optimistic, and I think they don't believe probably themselves.
We'll get to China a little bit, but I wanted to go back to your first point about, shrugging off geopolitical tensions. What would you be watching for as being a meaningful development in the Middle East that would change your outlook?
I guess that I was listening to Bill, a previous person, and I think he used a very word. It's not unusual. It's not typical to announce the kind of thing. So, it's hard to, speculate on geopolitics. But I believe that U.S. probably cannot afford Iran out of the equation, and that would really spike up the oil prices, and U.S. elections are ahead. So I guess this is another, announced kind of a move, which will not amount to much like the last time around. So my view would be that from a fundamentals perspective, we should not read too much into this geopolitics. Yes, some hot air, some few dollars up, but we are not talking the 90s or the 100s here.
What about disruptions in other parts of the world, for example, in Libya's oil fields, or say even U.S. inventories declining?
Now, good question. I guess that the supply side, we do have disruptions on Libya, also some disruptions probably in the Venezuelan side of the market. But I think let's look at from a broader perspective. I guess there is enough spare capacity in the world with OPEC, right? I call it, we live in the world of global spares and local scares. So there are situations where globally we are, I would say, enough spare capacity. But it's some of these scares which will lift the market once in a while. But I don't want to put too much emphasis on these disruptions to perk up the market or give it a huge boost. I think $80 to $90 per barrel. But the most important question I think you mentioned about the U.S. stocks is that it's the backwardation in the market that I believe is the most important metric to watch rather than the oil price. I believe OPEC Plus does not want to create any incentive in the market to enable crude oil storage. So that would be, my take, that watch the backwardation, not so much of the price levels.
How much does China factor into all of this?
A lot. I guess China has been, there has been slowdown in the first half for sure in their crude buying, in their product side of, they have been slowed down. They have been cutting refinery runs and crude demand in some of their teapot refineries. But I believe they have enough capacity to increase runs. And some of the big players, the NOCs, will probably increase runs and compensate for the refinery runs going down. So our view is that China, by come September, will probably will pull more crude than what people anticipate. And then they will use their higher product export quotas to put probably products in the market. So I guess that our view is that China's narrative is probably more bearish than what actually will turn out to be.
How do you expect the result of the US election to potentially impact shale activity, given that it's been so flat when it comes to exploration?
Now, I think that's a question on a lot of people's mind. I think there is a key distinction between the U.S. shale and rest of the conventional oil production is that the U.S. shale declines very fast, like 20%, 30% in the first few months or so. So it's kind of running on a treadmill. This year, we believe that the U.S. total crude production will probably grow by 400 KBD, which is quite a lower number compared to the 900 or million barrel they touched previously. Next year, also, we believe, even if U.S. election and there is a regime change and drill, we heard the news, but I believe that this is unlikely to happen for two reasons. One, they don't have the inventory of the wells they had drilled. The COVID era wiped out the DUCs, what we call drilled and uncompleted wells. And the second factor I would say is that we are sort of in a petrochemical down cycle. U.S. shale crude is a light sweet barrel. It's good for petchem market, and until the petchem market recovers, we don't see that there is going to be an absorption. We have just too much of light crude in the world, and I think that will put a back pressure on the U.S. shale.
Mukesh, Sahdev, good to have you with us. He's the head of oil trading and downstream at Rystad Energy. And of course, at a time when we continue to see a lot of movement in the commodity space, we continue to watch oil after the second best day of the year for WTI in the overnight session. We're seeing a little bit of downside, 0.6% for Brent at this point. We're watching iron ore as well as copper, which is down 0.2%. We were hearing that BHP and union leaders at the Escondida operation in Chile are sitting down for one last session of mediated wage talks. And this, of course, in order to avoid that strike at the world's biggest copper mine. We have more ahead. This is Bloomberg.
Take a look at how we're faring when it comes to Asian markets. A bit of a split market at the moment when it comes to sentiment. We're seeing some gains there with the Nikkei 225 just kind of playing catch up after being closed, of course, for the Monday public holiday. We have seen that resurgence of the yen as a haven trade as well as geopolitical concerns continues to weigh in this part of the session. We're seeing some upside momentum for crude prices. So watching those energy producers in particular. Japan really showing leadership, though, at the moment with the broader MSCI Asia Pacific now sort of trading at or above the levels that we saw prior to the August 5th rout. The Kospi is looking flat. The ASX is looking flat at the moment, quite preoccupied with some big earnings and continuing to watch out for the financials, in particular Commonwealth Bank of Australia, which is expected to see a little bit of a moderating when it comes to those numbers. They're taking a look at what we're watching when it comes to the structural kind of changes to the MSCI. Those global indexes seeing some changes in the quarterly index review. A lot of deletions out of China, 60 deletions for the China market, 7 new additions in India taking effect at the end of August. And these changes potentially just sort of moves India even closer to China's weighting in the MSCI Emerging Markets Index as we continue to see kind of really the growing heft of Indian stocks, right? We may almost see it come nearly on par with the weight in MSCI EM as well. And a lot of strategists saying that this could potentially make that gauge a little bit more balanced as well. China at the moment about 22%, 22.33% of that benchmark. India just under 20%, Shery.
Right, Haidi, as Hong Kong property prices languish around an 8-year low, the prolonged downturn is now choking off one of the financial hub's most important sources of government revenue. For more, let's bring in Hong Kong real estate reporter Shauna Kwan. Shauna, so what is happening with Hong Kong government's funding model here?
Yeah, so in the past couple of years, we've seen probably downturn, in be it the residential market or also the commercial office sector. So this has led to a slump in land sales revenues because developers are not bidding land, or even if they bid, they are offering very low price. So that has led to a conundrum for the Hong Kong government because, for a long time, the government has relied on this, very significant amount of land sale revenue to maintain its low tax system, which enable Hong Kong's business hub status.
What do we see in terms of action from the government then?
So, first of all, the government says that it is cutting expenditure, but then it is not so easy because Hong Kong like many other developed cities, is having a problem of aging population. So we expect welfare expenditure to rise. And Hong Kong also has a lot of ambitious infrastructure projects that would cost billions of dollars. And like I said, Hong Kong also cannot raise tax very easily because it will deter even more like workforce and also capital inflow. So what it's trying to do now is to raise more debts. To be sure, Hong Kong has the capacity to do so. But in the long run, Hong Kong has to think more about how it can diversify this revenue stream.
What options are there in order to do that?
So a lot of analysts said that, in the long run, Hong Kong has to build more new industries so that we cannot just rely on finance industry and real estate industry. Maybe tech could be a way out, but then it would take years. So I guess in the short run, the Hong Kong government has really to think more about what it's going to do with its future.
And it's selling.
Our Hong Kong and real estate reporter Shawna Kwan there with an existential crisis, of course, for Hong Kong. Now, the latest corporate stories that we're following at this point, Bloomberg has learned Johnson & Johnson cleared the key hurdle in its $6.5 billion plan to resolve thousands of lawsuits by people saying its baby powder gave them cancer. Sources say more than 75% of the group signed off on the company's settlement offer through secret balloting. The result would help J&J's efforts to contain liability to a unit it's set up to resolve the lawsuits. The litigation is ongoing. A Bloomberg analysis of government data shows U.S. retailers, including Walmart and Target, are selling generic versions of the cold medicine Mucinex that contain a cancer-causing chemical benzene. The chemical is unlisted, found inside a cheaper version of an inactive ingredient in the store brand option. U.S. regulators have ordered the ingredient phased out, but the deadline has been pushed to 2026 after industry complains. BHP Group is ramping up efforts to avoid a strike at the world's biggest copper mine. The company says it presented a new wage offer to union leaders in Chile, which includes a nearly $30,000 signing bonus and improved benefits. Failure to get the union's approval would set up a stoppage at BHP's Escondida mine, which accounts for about 5% of all the world's mined copper. Haidi.
Take a look at some of these stocks related to the Adani Group and how they're sort of faring, given we saw the decline on Monday as Hindenburg Research with their report, the sort of row with India's regulator continues to develop there. We did see the drop in a number of these names, in particular when it comes to Adani Energy Solutions, seeing kind of the steepest drop of 3.7%. Hindenburg Research accusing India's chief market regulator there of having conflicts of interest that prevented a thorough probe into fraud allegations against the group. And we did see a number of these stocks, though, pairing initial steeper losses. Adani Enterprises, for example, at one point was trading as low as 5.5% earlier, but all but 2 of the group's 10 stocks did end lower there against a broader market that was kind of little changed. In that report that was out on Saturday, saying that the chairperson of the Securities and Exchange Board of India and her husband invested in offshore entities that were allegedly part of a fund structure in which the brother of Gautam Adani also had investments. Both have denied wrongdoing, so we continue to watch for further developments in this story. More ahead on the Asia Trade. This is Bloomberg.
Well, Heidi, we were very much awaiting the conversation between Elon Musk and Donald Trump on X. It seems that that's been delayed given DDOS attack on X. This, according to Elon Musk, that he's now saying that there appears to be a massive attack working on shutting it down. That was some 18 minutes after the event was scheduled to begin. So it looks like we might get the full audio of their discussion after that conversation has concluded. But suffice it to say, of course, as we continue to watch the election season in the U.S. unfold, we have seen Donald Trump trying to regain attention after Vice President Kamala Harris has really gotten that boost from the polls recently.
Yeah, and we're hearing sort of more spending planned, right? This pro-Trump PAC planning $100 million in a new ad blitz as we see the Harris-Walz campaign really gaining traction. And I suppose this was sort of a Trump campaign that was taken a little bit by surprise by the switch when it comes to the leadership and the candidacy and, of course, the popularity of her selection for vice president candidate as well. So we're hearing now that Super Political Action Committee backing Donald Trump, planning to spend that $100 million on advertising between now and Labor Day. We are still awaiting to see in terms of what this conversation between Elon Musk and Donald Trump will bring us, right? Elon Musk had said, you know, basically everything is on the table, that there's no sort of off-limits topic, but of course they're getting a late start after what Elon Musk himself said was a distributed denial of action attack there.
One of the biggest events to watch this year, definitely for the markets on globally, right? As we continue to see that rally in Japanese stocks right now, we are talking about surpassing those levels that we saw before the Black Monday session last week in Tokyo. Of course, that incredible plunge being really boosted again throughout the week, and now we're back at levels as if that day hadn't happened. The China market open is next. This is Bloomberg.